really happy to be here with you. I just wanted to quickly do one check because Ross from the Rabbit City Library mentioned she might want to say a few words, but I don't think she is here yet.
She
So,
mentioned she cannot make it today, so
okay,
go ahead and start without her.
great. We'll just go ahead. Yeah, again, great to be here with you. And let me introduce myself briefly. I'm going to share my screen. So you should see it momentarily. Yeah, as Tina said, my name is Chris Menzel. I'm a financial advisor with Edward Jones. My office is in Burlingame. I have clients all over the peninsula in San Francisco and also some out of state. I provide financial advice. I manage investments for my clients. My purpose really is to improve the lives of our clients and help them achieve their financial goals. And a lot of times that's really retiring with confidence and making sure the money lasts throughout retirement. Now, we take a holistic approach to our clients' finances. So we help, as I said, with investments. So we can invest in stocks, bonds, treasuries, mutual funds. But we also look at options such as annuities, life insurance, and long-term care insurance. So we really want to just find the best solutions that work for our clients. Quickly, Edward Jones, we have been in business for about 102 years. We're headquartered in St. Louis, so we're not sort of a traditional Wall Street firm. We're more of what we say a Main Street firm. And we have branches in almost every city and town in the US and Canada. All right, so today wanted to just say a few things about the market up front, and then talk about how we think about retirement, putting strategies in place for retirement around your finances. And yeah, want to make this, if possible, as open as possible. So if you have any questions along the way, be happy to take them anytime, or of course also at the end. Okay. Then let me switch over. Just give you a quick market update, if you will. This slide just shows the market returns over the past roughly 15 years. In red, we have the S&P 500, which roughly represents the US stock market. And then in blue, we have the bond returns. And you can see a lot of positive years. 2022, you probably remember, it was a down year. That's when inflation spiked. But then the past 2 years over here, we've been positive, definitely in the stock area. The bond market has been positive as well, but has been lagging a little bit. And reason for that is that we have still very high interest rates. This curve shows interest rates back to 1993. We're now over here, 2024. So interest rates are above 5% right now. That's historically very high. And we're looking at interest rates coming down relatively soon. Very likely it will happen this year. We see the first cut from the Federal Reserve. Yeah, that's sure you've all felt the impact one way or another of these high interest rates. There's good and bad things, right? It's challenging now to buy a home because mortgage rates are high, car loan rates are high. On the other end, we have an advantage for savers. So CD rates have been very high and are still high. And then we have treasuries and bonds as interesting investments right now. And another thing that we've been looking at for our clients is refinancing. And You probably know refinancing for mortgages, right? So when you look back here in 2009, really to 2021 timeframe, interest rates generally have been pretty low, and it was a good time to refinance your mortgage, get the lower interest rates because you want to pay as little as possible on interest. Now, if you own an annuity, it's kind of the opposite because you want interest rates as high as possible to earn as much as possible. And so right now is a good time to look at that and potentially find good solutions for an exchange of an existing older annuity. So an interesting period in the markets. Again, high stock market and also high interest rates. Okay, let me switch back here. I wanted to show a couple more slides on this. Yeah, just on the market. So this curve kind of shows the market back to 1996. You can see there's ups and downs, but generally an upward trend. That's what is normal. If we go back further, markets tend to go up over the long period. However, in the short time, we can experience dips. That's normal. Let me show you one statistics here. The right slide up. All right, so moving a little slow, but we're getting there. Okay, one more. Okay, so this shows you the statistics of market, what we call dips or corrections. So 5% market drops happens actually 3 to 4 times a year, and a 10% drop in the market happens about once a year. And then more steeper drops happen a little less often, but so 10% drop is quite normal. And usually the market recovers by the end of the year, and we still end up 3 out of 4 years on average positive in the market. So that's always something to keep in mind when you invest, that short-term dips are normal. Okay. And let me know if you have any questions. I'm switching over now to the other topic I want to cover, and that is thinking about strategies for retirement, right? We want to always make sure the money lasts throughout retirement. And there's a few things to think about and some strategies that can work. Okay, one thing up front is it's important when you start planning for that. And we have a 5-step process that we like to implement. It's about understanding where you are today and what you have in place. And then number 2, really understanding what your goals are, where you would like to get to. And then it's about bridging that, right? Can you achieve those goals? Some might be very realistic, some might be a little bit of a stretch. And then we'll look at strategies, how we can achieve the goal. And of course, I think almost most importantly is that we regularly revisit the plan and the strategy to make sure that you are on track. When we think about goals, we also think about prioritizing them into needs, wants, and wishes. So a need is something like shelter, like housing, right? Food, transportation. That we can't compromise on that. That's necessary. Wants might be an annual vacation. That's high priority for a lot of people. But it's something you could live without maybe for a year or so. And then wishes are more challenging goals, maybe buying a second home or yeah, taking a very long cruise, things like that. Okay. Moving on, if we look at the planning for retirement, we want to, yeah, plan for the expected. That's the first thing. And we want to understand, yeah, what your retirement should look like, right? It's important to think about that before you start detailed planning. Again, do you want to travel a lot? Do you want to work part-time? Do you want to volunteer? And yeah, it's important to think about where you want to live and what kind of house you might want to live in. One topic in retirement is also downsizing. That can be an option also to help free up net worth and make it liquid. Because here in the Bay Area, a lot of people's net worth is tied up in housing. Okay, then yeah, cost is of course an important factor in the equation. We look at, yeah, necessary expenses, discretionary expenses, taxes, of course, is a big factor in overall planning, and kind of, yeah, splitting that up, understanding where the money might be going. It's a good exercise to understand your overall expenses and what your income needs to be, right? Because you need to cover what you're spending. And when it comes to income, we have sort of two categories. One is called outside income here. So that would be like Social Security, maybe pension, maybe you have income from a rental property, things that you can count on pretty much to come in on a regular basis. Then the other part is savings and investments, right? So funds that you have saved for retirement, they can generate income in various ways. Yeah, so the difference really between what you want to spend and the fixed income that you have is also called the income gap, and that's what we have to cover from investments and savings. And there are some numbers I want to show you now. These are general guidelines. So when we look at an investment portfolio that you have for retirement savings, we can take out a certain amount per year to keep it sustainable. If we take out too much, then you're really going to draw down your portfolio and your savings, and then we cannot make sure that it lasts throughout your retirement. So these are general guidelines, right? So if you're, for example, in your late 60s, we typically target a range of 3.5% to 4% that we can take out for your retirement savings, but still maintain the account throughout your retirement. So it's sustainable, as we say. So that means if you, let's say you have a portfolio of 500,000 and we take out 3.5%, that would be 17,500 per year, what we can take out. Okay. Just quickly skip over that. So we have, yeah, an example here as well. Just again, kind of illustrating this, if expenses are 65,000, Social Security is 20,000 per year. So then the income gap is 45,000. That's what Tom and Julie in this example have to cover from investments. And if they have 750,000 and have to take out 45,000 a year, then this will be a 6% withdrawal rate. So this will be a bit high for the start of retirement. Then of course we got things to think about. if you have a situation like this, is it possible to reduce spending a little bit early in retirement? Can we delay retirement a little bit, or is there part-time work? So certain flexibility can be very helpful. All right, so we had sort of, planning for the expected, right? That's the expenses that we know will happen on a day-to-day basis, month-to-month basis in retirement. But we also have things that are a bit unexpected in retirement that is good to consider. Here's just listed a few things. So we know long-term care is a risk for everyone. It's hard to plan for that because you never really know if you need it. You never know when it might happen, so that makes it a bit difficult. Of course, we also don't know how long our retirement is, right? That's another challenge. Inflation is a topic, right? So we just experienced that over the past 2 years, where prices went up more than before, and there's ways, right, to address that in your retirement portfolio. Okay, so that's just a few here. We got the example here with Helen. It's around the health insurance. So these are typically things that we suggest to consider when you plan, right? It's Medicare and health insurance, right? That's a topic, especially for people who like to retire early before they're eligible to Medicare. Then health insurance can be a significant expense. But also around Medicare, there's different options that carry some extra cost. Supplemental health insurance is sort of that topic. But then again, as I mentioned before, long-term care, that can be a cost that's difficult to project. It's good to have a bit of a buffer in your portfolio for that. Or also for people that are still younger, long-term care insurance can be an interesting option because it can cover a significant amount of the cost. And Medicare, right, is actually not covering long-term care support. Okay. So I want to talk about inflation a little bit. Right, so a lot of time early in retirement, we feel like we want to be safe with our investments. We want to focus more on fixed income investments. We don't want to be exposed to the market too much anymore because we have to withdraw funds from our retirement nest egg. And so we don't like to see the fluctuations of the stock market. However, it's still good to also have growth investments, which are mostly stock investments, in your portfolio, even in retirement, because those help to keep up with inflation. If we have too much fixed income, then it's really what it says, right? It's fixed. The income is fixed, and it doesn't really keep up with inflation over the long term. And that's why it's good to have a balanced mix of fixed income and stock or growth investments, even in retirement. Of course, Social Security is a very good benefit when it comes to inflation as well, because we have cost of living adjustments there as well. All right. Yeah, so that's again, a balance depending on your goals, depending on where you are in retirement, between equities or stocks and fixed income can be very helpful. However, it's good to have both, right? I wouldn't say you should have everything in stocks as well, because then we have the situation that we rely on the market a lot, and markets do go up and down. So it's good to have a solid fixed income portion in your strategy as well. And there we also do look at annuities for our clients to build up the fixed income portion. Annuities are, the way they work, they're kind of like a pension. You put money in and you can get a fixed income out of it for the rest of your life. And that can be interesting to cover, fixed expenses. Okay. Yeah, so this is really sort of an overview of what I wanted to provide, of how we address planning for retirement, or financial planning in general, for goals that our clients want to achieve. Outside of retirement, what we do also is, of course, help people plan for college, for education. So college savings is a big topic, and some of our clients are parents who do that for their kids, but we also have grandparents who help their grandkids save for college, and there are some tax advantaged solutions for that as well. And as I said, protection, life insurance can be a good topic. It's really around protecting against income going away. So if we have a family and one of the parents were to pass away, then it's important to have something in place to make sure that the family can still afford a mortgage, can still afford to pay for the education of the kids if one of the incomes falls away. Okay. And at this point, I wanted to open it up for any questions that you might have.
Somebody said, is it still good to invest in T-bill?
T-bills?
Uh-huh.
Right, yeah. Yes, that is still, I think, a good short-term investment, mainly. T-bills offer very high security, very high safety, because it's really backed by the US government, so it's equally safe as a CD. And you get fixed terms, so you know when the T-bill matures, you know how much interest you're going to earn on it, so you have that guarantee. And the rates are still quite interesting. So that's a good way to put some money to work that might be sitting in a checking account and not earning any interest. Also, savings account, unfortunately, mostly don't pay that much anymore. And the good thing is, with T-bills, there's lots of different length of terms. Really assured as 1 month, and up to 1 year, right?
So the 1 year would be higher interest rate, I would assume.
Yeah, that's interesting. Actually, right now, it's kind of like it's the opposite. In the regular environment, that would be correct, but where we currently are, right, is in a very high interest rate environment, and the expectation is that rates will go down in the next few months, over the next year. And that's why longer treasury bills and longer CDs actually pay a lower interest rate than the shorter ones. They're just reflecting really the expectation of the general interest rate environment.
Got it.
but still definitely a very good way to make your money work. I have clients who are looking to buy homes. They're not quite ready yet. They might want to do that in a month or two. And treasury bills are a very good way to park your money and get good interest until you need the cash.
What is the current interest rate for T-bill now? 5%?
It's a little lower now. Has ticked down a little bit. Checked this morning, so they're between like 4.2 to 4.8% in the 1 year time frame.
Got it. Question, another one is, with interest rate going down, what should we invest in?
Yeah, so that's a very good question, and there's not sort of one answer that's right for everyone, right? Because with investing, it really depends on your time horizon. If you want to invest for the long term, right? If you don't need your money within the next year or two, maybe you don't need it in 5 years, you really, yeah, invest for the longer term. Maybe your retirement is 5, 6, 7 years out. Maybe you have funds that you don't really need. Maybe you want to actually leave it to the next generation. So if you have a longer time frame, then the market is a very good place to invest because it offers the highest return over the long term. Now, along the way, we might see some ups and downs. That's what you have to be prepared for if you invest in a diversified portfolio. We can lower, of course, the risk through diversification, but we'll always see market swings. But over the long term, I'm convinced it's going to offer the best return. Now, in the shorter term, right now, if you want to invest for, let's say, 2 to 3 years, bonds can be a very interesting option because we know that interest rates are very likely going to come down. That's quite certain. And with interest rates coming down, we also know that bond prices, the value of bonds is going to go up. That's an inverse relationship. So if we go back 2 years ago when interest rates went up, when the Federal Reserve increased them to fight inflation, bond values came down. And over the next 2 to 3 years, it's very, very likely that we're going to see the opposite, and that we see bond values go up. And of course, with bonds, you can also earn interest along the way, right? So you have that double earnings potential through interest that they pay and through the value going up. And that's a very good outlook over the next 1 to 2 to 3 years. And yeah, in the very short term, again, 1 year time frame, we still have very good CD rates and treasury bill rates. That's very, very interesting as well. And then, yeah, the last thing I want to mention, and I pointed out briefly in the presentation, is annuities. Also, again, they offer higher rates when interest rates are high, and we're still in that time frame. In fact, the annuity rates that we see right now, we haven't seen that since about 15 years ago, after the financial crisis. So it's really those are very good opportunities right now.
Great. The next question is, what are your suggestions for a 61-year-old in good health who plans on retiring at 67, has some retirement savings, does not own a home or any property?
Yes. So yeah, again, I wouldn't say there is sort of only one thing you should be doing. But at 61, it's a very good time to plan for retirement and think about retirement. You still have several years left, right? To actually save more. Yeah, not owning a home is no problem. In fact, that probably gives you a bit more flexibility. I would recommend to really generate a plan. A lot is gonna going to depend on how much you've already saved up at this point and how much you expect to spend in retirement. But in general, I would be looking most likely to have a mix of solutions, right? Making sure there is going to be enough fixed income to cover fixed expenses, but then still also have a portfolio in place that will grow from now until retirement, but also during retirement. So those are, kind of like the general thoughts. And again, of course, it always depends on the specific situation, what someone's goals are in terms of spending throughout retirement, and the priorities, really.
Great. We have another question. What is tax advantage to help grandkids get through university? And the same person also asked, do you know any companies that offer long-term insurance with savings?
Yeah. So one option that works for most people, and when it comes to college savings, is 529 plans. There you put the money in, and once the money is in that account, in that plan, and you later use it for college or education, you don't have to pay tax. So you can earn interest and dividends in your investments. Your investments can go up. You can have basically capital gains, but there's no tax on any of that. And so that can be a very, very good vehicle to save for college. There's also some new options that are now available with the Secure 2.0 Act, right? Because some people have concerns about, well, if I put the money in, what if my son or my grandson, my granddaughter gets a scholarship and doesn't even need money for college? What do I do then, right? So one thing actually is that's been in place before. You can then take money out in the value of the scholarship, penalty free. And the other options that we now have is the 529 funds can actually become Roth IRA accounts for the child. It takes some time to be able to make the conversion, but that is a strategy that can work out very well, because again, you wouldn't have to pay tax at any time on the funds. And the funds, if you don't need them for college, they could become Roth IRA funds for the child. So it could really kickstart retirement savings for the child. Another option that you have with 529 accounts is that you can always change the beneficiary. So if you have several kids in the family, and you have it set up for one kid, and that kid doesn't need that much money for college, then you could change the beneficiary to another kid that can then fully cover that the second kid's education. So there is quite some flexibility to make it work well for the family. Then the other part of the question was the long-term care insurance companies, right? So yes, we do have partners that we work with. So Edward Jones is not an insurance company, so we do not offer our own insurance products, but we have partners that we work with that offer insurance, long-term care insurance. And so that's what I do on a regular basis, for clients. If anyone has more questions around that, I'd be very happy to talk more on a phone call or in-person meeting.
So with that, there was one more question that's relevant. How much does an Edward Jones advisor charge?
Yeah, very good question. So it depends because there's different ways someone can work with me. So one thing that's important to know is that there's no cost sort of to talk to me. If you wanna sort of have chat about what you might be looking for and find out if I might be able to help you. There's no cost for that conversation. Now, if I work with a client, there's sort of two general models that we have. One is a transactional model, where there's a cost to buy or sell investments. And then the other is a more delegation and managed model where we do manage accounts for clients that don't want to be involved on a day-to-day basis. Yeah, there's a cost based on the total assets that are invested. Most of my clients pay anywhere between 0.7 to maybe 1.3% of their invested assets. Again, it really depends how much service someone prefers to have, and what type of accounts and how they want to have their investments handled by us. Okay.
Any more questions? Do you have your contact slide?
Yes.
Maybe that will be the next
Yeah.
thing. Yes. Let me put this phone number.
Bigger.
Chris, I'll type it in, Chris 650. And do you advise them to call you? If they need-
Yeah, calling me is very good. So there's always someone answering the phone between 8 and 5.
Right.
And just noticed my email address isn't on here. That's another
Yeah.
good way to contact me. And so that would be chris.menzel@edwardjones.com. I can maybe also put this in the chat.
Chris, do you also do will and trust planning?
Very good question. Yeah, and I think that's a very important piece of someone's overall financial plan. So we don't do that ourselves. I'm not a lawyer, right? And we do not have estate planning attorneys in-house, but I do work with local estate planning attorneys. And that's always something we talk about with our clients as well. Because yeah, if you have property, especially, and if your family situation is a bit more complicated, then a living trust can be a great tool to make sure that if something happens to you, that your assets are going to where you want them to go. We do, of course, try to make sure that everyone has beneficiaries for the accounts that they have with us. So we can sort of cover part of it, but in most cases, it makes sense to have a living trust.
Great, thank you. Anyone else has questions for Chris? Thank you so much. It's been very educational for me.
Yeah, you're very welcome. It was great. Thank you for giving me the opportunity to speak to you. And again, if anyone who has any questions, like to discuss things a little further, I'd be very happy to chat. Just reach out to me by phone or email.
Thank you. Bye-bye.
All
Thank
right.
you.
Bye, everyone.
Bye.
Have a wonderful rest of your day.